along to the half-year update. Before I get into the overview itself, I'd just like to talk briefly about the current economic environment. The New Zealand economy has continued to grow moderately in 2012. Since the lowest point of the recession in the June quarter of 2009, the economy has grown by an average of 2% per year in real terms. There has of course been considerable headwinds for that growth. The global financial crisis has had a profound effect on developed economies and continues to do so, as we've seen with downward revisions of growth in most developed economies just in the last few months. And improved household savings in New Zealand is also weighing against our short-term economic growth, as is the government's fiscal consolidation. In terms of our fiscal position, we remain on track for surplus in 2014-15. So we remain well placed compared to most other countries. It's important that we stick to our program and carry through with the policy and the fiscal consolidation that we've embarked on. Just to remind you of the government's overriding priorities, which the Prime Minister talked about at the beginning of this year. First, responsibly managing the government's finances by returning to surpluses and reducing debt, which we'll talk about later. Secondly, and very importantly, pushing ahead with a cohesive program of microeconomic reform through the business growth agenda. This is focused on supporting businesses and giving them confidence to invest, to grow, to employ more staff, and to improve New Zealand's competitiveness, which will enable us to export successfully. Our third priority is driving better results for New Zealanders through value for money for our public services. Our success here is measured not on how much we spend, but on the results that we achieve. And finally, supporting the rebuilding of Christchurch. Our Treasury estimates that about 4.6 billion of the 5.5 billion Earthquake Recovery Fund will have been allocated by June next year. The budget policy statement covers progress on each of these areas in some detail, and in each of those areas we remain on track. This is just outlines the global situation. It's become clear that the immediate global outlook has continued to deteriorate. Just last month, the OECD again downgraded its growth forecast for 2013. It now expects growth across the OECD of just 1.4% next year, the same as it is forecast for 2012. And as they have said themselves, the world economy is far from being out of the woods. As you can see from this graph, the outlook for 2013 is somewhat worse across the board. These forecasts will continue to move around, but there's no doubt that we will for some time yet see Europe and the US deal with the problems of low or no growth and too much debt. And of course, how they deal with those problems will continue to affect New Zealand. The high Kiwi dollar, which is largely a factor of these weaknesses offshore, and it is a headwind to our efforts to tilt the economy towards exports and away from debt-funded consumption. It would be nice to be making more progress on that. You will have seen the growth forecasts. They include the expected impact of the latest downgrades to international growth forecasts. We will grow at between 2 or 3% each year for the next 4 years at an average of 2.5% a year. Contrast that with the near-term forecast for the OECD at around 1.5% for the next couple of years. This is down on the forecast growth of 2.5 to 3% in budget 2012. So the forecasts have been roughly reduced by about 0.5% per year for the next 4 years. Despite these slightly lower forecasts, we are still expected to grow more strongly than the Euro area, the UK, Japan and Canada, similar to the US, slightly faster, and a bit slower than Australia, where their forecasts currently average around the 3% mark. These overall downgrades in growth in our trading partners, as well as the dampening impact of New Zealanders saving a bit more, is affecting our revenue. However, we need to sharpen our focus on the factors we can influence, which is government spending, the competitiveness of our businesses, and better results from our public services. Now turn to the labour market outlook. Most New Zealanders, of course, still have jobs or have found new ones and are enjoying the benefits of mortgage interest rates at 50-year lows, inflation at a 13-year low, and moderate real wage growth. And of course the strong Kiwi dollar gives them international purchasing power at a level they haven't seen for a long time. But these are the benefits of those who have jobs. Of course, too many people don't have jobs, and there's no doubt that the employment market remains weaker than we would want to see it, and weaker than the budget forecasts. The unemployment rate reported for September of 7.3% surprised most forecasters and appeared to be somewhat out of line with other indicators, but nevertheless the rate is too high. These forecasts show the labour market improving over the next 4 years to fall below 6% by 2014-15. We'd like to do better than that, and for many New Zealanders we need to do better than that. There is something of a risk of getting caught up in the quarterly data, which jumps around. The next quarter is who knows where it could come out. It might be under 7%, it might be higher than 7.3%. What we want to do is focus on the underlying drivers of employment, which are businesses who have the confidence and the investment capital to grow and employ more staff. And our focus on that is through both the activities of government, through our own investment, for instance in infrastructure and in housing, but also working very closely with businesses through the business growth agenda. We've published documents already on exports, innovation, skilled workplaces, infrastructure and natural resources, setting out a very broad-based policy program, and earlier in the year we will publish the final document in the series on capital markets. This is the forecast for new jobs over the next 4 years. The number of New Zealanders employed is forecast to increase at an average of 1.6% for each of the next 4 years. Treasury forecasts that the number of people in employment as measured by the HLFS will increase by 131,000 between September 2012 and March 2016. Over the past 3 years, around 65,000 more New Zealanders have gained employment. There is no doubt, though, that since the recession, employment growth has been flatter than forecast, reflecting a number of things, but also reflecting the resilience of our labour market through the recession. More people kept their jobs through the recession, but had their hours and their pay cut. Businesses are now understandably preferring to increase the hour and the pay of existing workers rather than hire new staff until they need to. The current account deficit is expected to be slightly smaller than those forecast in the budget 2012. It's expected to increase from current levels as economic growth picks up, and that increase over the next year or two is driven primarily by investment. This will see higher imports, only partly offset by ongoing export growth. For a while, continued low global interest rates are expected to hold down the investment income deficit, but in time, increased company profitability will see the investment income deficit increase again. As the graph shows, if we exclude one-off Christchurch rebuild effects, that's the yellow line, the current account deficit ranges between 3 to 5% over the next 3 years. Even including the rebuild, the situation remains considerably better than in the mid to late 2000s, when we reached record levels and sustained them of between 8 and 9% of GDP. The latest forecasts have been driven by a much higher share of investment in GDP. In fact, rather than lower savings. In fact, national saving is forecast to increase as the government moves back to surplus. But as we've said before, the current account deficit is a long-standing problem going back nearly 40 years, and it will take some years to turn around. But I think everyone's realised that the world is not going to allow us to finance current account deficits at some of the historically high levels we have seen. We'll now turn to the fiscal forecasts. Despite the slower than expected economic outlook, we remain on track to the target of surplus in 2014-15 and keeping core Crown debt below 30% of GDP. The effect of slightly weaker growth and therefore lower than expected revenue has been balanced out by a forecast decrease in spending, particularly on welfare payments and finance costs due to lower interest rates and inflation. The forecast surplus of 66 million is not large, but we're headed in the right direction. We still have 2 budgets and 2 half-year updates before reaching the point of 2014-15, and as we've seen in the last 2 or 3 years, an awful lot can happen in that time. Nevertheless, it's something of an achievement to be on track to surplus despite the lengthy recession, ongoing uncertainties around the performance of the world economy, and the very considerable costs of the Christchurch rebuild. The budget next year will confirm the government's commitment to responsible long-term fiscal management, and that will require starting to think beyond the surplus target time of 2014-15. It is important we remain focused on getting back to surplus, but beyond that point we need to start to bring down debt to more prudent levels, to rebuild a buffer for resilience to future shocks, to help build national savings, and of course to start actually paying off debt. So surpluses beyond 2014-15 are a key to being able to exercise those choices, including then options about resuming payments to the New Zealand Super Fund and targeting more investment at priority public services. So in that context, expenditure control of the sort we have seen now are really a semi-permanent part of being government. The need for control does not expire once we get to surplus in 2014-15. The latest forecasts show the government is on track to reduce Crown expenses to around 30% of GDP by 2015-16. This will be achieved, as it has been so far, with moderate changes over time and without radical cuts to government programs. When we became the government, core Crown spending was forecast at around 35% of GDP, driven at that stage largely by the upsurge in spending after 2005. And of course the ratio was then maintained by the decline in GDP through the recession. So we've taken the approach of understanding the principal long-term drivers of government spending and bringing those long-term drivers under control. That is what has allowed us to continue to improve public services while we have tight expenditure constraint. Our approach is taking pressure off inflation and interest rates, and in the long run helping to free up resources to grow New Zealand's tradable income earning sectors. The budget policy statement confirms that the operating allowances we announced in Budget 2012 remain in place. So we are not achieving surplus at the cost of future options. Those operating allowances remain at $800 million for Budget 2013, returning to $1.2 billion for Budget 2014, and growing at 2% per year for subsequent budgets. In order to maintain this kind of buffer and choices about how to use the allowances, we will continue to reprioritise expenditure into those areas where we can get results, from those areas where we aren't getting results, and require government departments to find efficiencies. Government departments are in the first 6 months of a 3-year program of making $1 billion of savings. On coming into office in late 2008, the government was presented with forecasts showing ever-increasing government debt. It's worth remembering that at that time we were not anticipating the financing of the Christchurch earthquake, where the total cost to government is around 12 to 13 billion, nor were we expecting at that time the protracted recovery that we're now experiencing. So we worked reasonably hard to rein in spending and therefore bring debt to a peak at under 30%, and that remains the case in these forecasts as it did at the budget. Because of the slightly lower GDP forecasts, the half-year update has us just missing our target of further reducing net debt to below 20% of GDP by 2020. However, that remains our target and we will be working hard to meet it over the next few years. We will have a slightly higher profile of debt, and that is driven by the fact that while we reach surplus in 2014-15, the surpluses forecast beyond that point are smaller than was the case in 2012, which means the government will still be running cash deficits, will still require small amounts of new borrowing. As part of our prudent approach to managing debt, over the next 4 budgets we will use existing capital from the government's balance sheet to finance new capital investments, in particular the $5 to $7 billion proceeds of the government's share offer program, which will be allocated through the Future Investment Fund, and we'll set out more details of that allocation in the budget next year, when we expect to have completed the first float. In assessing New Zealand's overall debt situation, we need to look at trends in household debt, the yellow line here, as well as government debt. Over the past 3 years, New Zealand households have broadly matched their spending and their income. This has helped to stop the relentless rise in household debt that had occurred through the previous 15 years, and to allow for a modest reduction in household debt as a percentage of GDP. And this, of course, enables households to have a greater sense of security that in a world hostile to debt, they are reducing their own. But at around 90% of GDP, down from a peak of 96%, household debt levels remain too high, and it is likely that households will continue to try and reduce their debt where possible. Our household debt is right up there with some of the higher levels such as Canada, Spain. It's above US household debt, it's above Japanese household debt. So while household debt is coming off its peak, that has been more than offset by the rise in Crown debt, which will continue until we get back to surplus. Reducing New Zealand's total debt to accepted levels will require a concerted effort from households and the government for some years to come. While the government can make choices and decisions that impact directly on its spending and debt tracks, it does not have the same control over revenue. because these are subject to the performance of the wider domestic and global economy. We've just completed the first full year of the tax changes announced in Budget 2010, when we increased taxes on consumption and property speculation and reduced taxes on work and savings. And as you can see there, the impact of the recession has been considerably less tax revenue than was expected in late 2009. Looking beyond 2014-15, I'm confident that we can continue to make significant progress, provided we stay on track. The government is looking out beyond the next 2 or 3 years to ensure that fiscal and economic changes, which are vital to maintaining New Zealand's debt levels at prudent levels and enhancing our competitiveness, we want to make sure that these changes can endure and give us more choices for the future. We will need to build a buffer against future shocks, which will mean consistently running surpluses of at least $2 to $3 billion so we can repay debt, resume contributions to the super fund and invest in priority public services. This will require us to continue with considered and consistent change over time beyond the focus on the surplus target in 2014-15. So at this half-year update, we want to confirm that we intend to stick to the plan we've outlined through 2012 to focus on more jobs and higher incomes. We are making reasonable progress in the context of a changeable and difficult global environment. We should increasingly be able to focus on the positive opportunities ahead of us over the next decade. Our trade and investment links are increasingly with the fastest growing region of the world, directly with Asia and through Australia to Asia. In the next 5 years, China, India and the ASEAN countries will increase their share of world GDP by nearly 20%. So a significantly greater share of world economic activity will accrue to the markets which we are closer to. Our terms of trade, despite coming off near record levels, remain historically high. We are selling more of our exports to countries with growing appetites for protein, and we are extending our free trade agenda. Our businesses are becoming more competitive, and the Christchurch rebuild is forecast to contribute about 0.7 of a percentage point to a year to growth in the forthcoming, the next 4 years. So we're in a strong position to translate these opportunities into more jobs, higher incomes, higher living standards and continued income growth for New Zealand families. Any questions?
Will you be prepared to cut spending if you're not going to meet that surplus target in years to come?
Well, I think as we've said, we're not willing to get to surplus at any cost to the economy, because we're already on a pretty solid rate of fiscal consolidation. We've built in some buffers in terms of the allowances out ahead of us, which give us some choices about getting to surplus. And we will continue with the expenditure constraint. We get another look at that over the next 2 or 3 months as we head into Budget 2013.
You make a comment in the budget policy statement that you've decided against making any further cuts to ACC levies and you refer to the budget position. Had you done that, would that have turned your projected surplus into a deficit?
Yeah, there's a couple of areas where governments make decisions on the merits, well, in a self-contained way, but they do have an impact on the track to surplus. So one is ACC, where at this time of year the board makes recommendations about levy reductions, and we've been keen to make sure that before this we reduced levies last year by 600 million, and we want to make sure that before there's further reductions that the gains in ACC are actually locked in, so we're not cutting levies and then putting them back up again. So that does have an impact on the books because we didn't take a reduction. And the other one is around NZTA. So the roading fund is, from hypothecated revenue, so it doesn't take money from the general government budget. Because we want to bring forward the start dates for a number of those major projects and make sure we've got a sustainable fund. Mr Brownlee announced some increases in the fuel excise starting from July next year. So that does have some impact on the surplus track as well.
So the reason for that announcement today is to help keep the books in order?
No, it's not. It's the reason for it is to maintain and in fact speed up the roading program. There's been a lot of work done over the last 6 months about the sustainability of roading funding related to the roads of national significance, the extra demands of Christchurch and so on. So there's been a package of decisions made that include, for instance, exploring a PPP for the transmission gully, discussion about the extent of borrowing NZTA should be allowed to do, and also the future track for the fuel excise.
But could you have made surplus if you hadn't increased these tax amounts?
It would certainly affect the track, yeah. I mean, if we'd taken, for instance, a big cut in ACC levies, the books wouldn't have got to surplus in the absence of other decisions. But I think that, so at the margin, those things make a difference. But the fundamental driver here has been the control of it, the ongoing control of expenditure. And really the main achievement there has been that despite 4 years of tight control, your public service has been able to continue to provide better public services, so we're not experiencing blowouts or unexpected service breakdown on any significant scale.
But you've had to raise taxes in order to stay on track.
Well, I mean, you can have a word game here, but the fact is we needed to sort out the transport fund. That has an impact on it. We've made some decisions about ACC, and yes, they have had an impact on the surplus track and assist us in getting there.
How big? What's it?
Oh, look, I'd have to go back and have a look at it. But it'll be, the sort of low hundreds of millions.
Did you give any consideration to slowing down?
200 million from the excise duty and 200 million from the ACC change. So you would have missed, this morning's announcement, it would have been 240 million in a hole.
Yeah, without the changes, we would have fallen short of the surplus track. Without the changes in transport.
Did you give consideration to slowing down your investment in roads?
No, we didn't, because we think that that's important for a couple of reasons. One is jobs. Bringing those projects forward will help employment. And the other is because we are very keen to get ahead of the growth curve with our infrastructure. If we hadn't had Christchurch, there wouldn't have been the same pressure to sort out, the same pressure on the transport funds. But it's just part of the government's balanced approach that at the same time as we're trying to get the government's books in order, we're also committed to investments which we believe are going to underpin future growth.
Just in terms of the ACC, the decision not to take up the recommendations, you say it's about preserving ACC's, making sure ACC's in shape to deal with its liabilities. But the wording in the documents, I take your point about not wanting to play word games, but it says ministers have taken into account that a reduction in levies at this time would have a direct impact on the Crown's operating balance. It sounds like the decision is driven by the effect on the balance.
Well, I mean, it is what it says. It was certainly taken into account because the operating balance includes ACC levies as income, okay? In the same way as it includes fuel and excise as income. So in the case of an ACC, the decision means we're not foregoing more income. Okay, so last year we, as I said, I mean, this is where you can argue one way or another that last year, if we hadn't taken $600 million of levy reductions, then our track would have been 600 million higher right through. Okay, so what we try to do here is, in the first place, make the decisions on the merits for the entity, the relevant entity, ACC and NZTA, and but we have taken into account the fact that they have an impact on the surplus track.
Why stick to this particular surplus target, given that the credit rating agencies are happy as long as you're on the path? So why be so slavish towards this exact date you've got to get?
I wouldn't regard it as slavish at all. I mean, slavish is what you're seeing happening in some other countries where there's all sorts of pushing and shoving of the numbers to try and get there, pushing expenditure back or pulling it forward or whatever. We've just found that it's a very useful anchor for government to make it clear to the public servants that the government is sticking to fiscal discipline, and for the public who are keen to see the government arrest its increase in debt. So in an economic sense, it could be plus or minus $1 billion, and it's not going to have a significant impact on the economy because it's a small difference between very large numbers. But in a sense of maintaining focus and discipline, we're committed to getting to that surplus.
But are you tied by the political commitment?
Well, we're certainly tied by the political commitment, but the political commitment was made for just the reasons that I've outlined. That in order to, for instance, keep the public service focused on the long-term quality of its spending and getting results, they need to understand in very simple terms the government is going to stick to the discipline. They can't just sit it out. And the same for the public. The public need to know that despite political pressures, the government is going to be using their dollar carefully so that we can achieve two things: better public services and also arrest the increase in debt. So the political commitment isn't just a political commitment, it's got a very clear purpose.
You've been accepting the sort of economic rationale that if it's $1 billion out, or 2014's election year, and the opposition parties will be saying you failed to reach your target, your promise. So how much does that weigh on it?
Well, their credibility will be tested on what promises they make in 2014 that are consistent with the target. In fact, as far as I'm aware, all the opposition parties support getting to surplus in 2014-15. So it's a good discipline on them too.
The forecasts, even though they're weaker, they still seem to be strong for most private sectors. Do you have any doubts about this Treasury just consistently too optimistic?
Look, from the work I've seen, they're about middle of the pack. Most forecasters have a pattern of being a bit, they underestimate growth when it really takes off, and they overestimate it when it's shrinking or flat. Treasury makes its, does its professional job of the forecast, taking into account the most recent information they can. I'm less concerned about the uncertainty around the forecasts and more concerned about the uncertainty of the real world, because that's actually what will drive our employment numbers and whether the government can, our growth prospects and whether the government can get back to surplus. So, yep, forecasting is one uncertainty that we have to deal with. It's never going to be perfect. What we try to do is build in enough resilience to our policy approach that we can handle whatever uncertainties the rest of the world is going to throw at us, and I think they're going to keep throwing things at us that we don't expect.
On migration numbers, what's going to change between now and 2015 in terms of 3,000 people going out and 12,000 people coming in?
I think the relative performance of the Australian and New Zealand economy is probably going to be the biggest difference. Bear in mind the recent migration figures were based on a time where Australia was growing at 4% and we were below 1%. You've only got to go to Australia now to feel the difference in the mood for a Kiwi getting off the plane in Queensland, looking at 6.5% unemployment and rising. It just looks a bit tougher than it did. So over the next 2 or 3 years, our growth will be a bit slightly slower than Australia's, but nothing like the large gap that it was through 2009 and 10. So that's probably historically the correlation in growth rates, or the difference between the growth rates correlates reasonably closely in time to the migration flows.
How weighted are you to the target for national debt to be very
Yeah, look, I think it's a bit like the surplus benchmark. In a sense, in an economic sense, if you're a few percent over it, it's not going to be the end of the world. There's many sovereigns with debt well in excess of 60, 80, even 100% of GDP. But for our kind of economy with very high levels of private sector debt, it's important that government maintains the resilience of the economy by having low levels of debt. And in this statement, there is the figures show that we're expanding the borrowing program over the next 3 or 4 years because the surpluses will be smaller than we're forecast. That is a concern, and we would hope over the next couple of years that despite the fact we're meeting the 30% measure, that we also meet the goal of achieving 20% by 2020. And on these figures we won't. We need to work towards achieving that goal of getting us back to the position where we can handle the next recession or the next earthquake.
How concerning is the drop away in tourism, and how can you encourage Kiwis to holiday in their own country?
Well, it is. There's a double whammy there with the exchange rate because it makes it cheaper for Kiwis to holiday overseas than in New Zealand, as well as raising the barrier a bit for tourists coming in. I think there's two things going on at once here. One is the impact for tourism. One is the impact of the high exchange rate, and the other is the big shift in markets. So the fact is, increasing tourist numbers are going to come from Asia, and the European markets are going to be quiet for some time yet. So it's a bit like the other sectors that we work with. We can work with the tourism sector to do as much as we can here in New Zealand with the factors we can influence to help them be competitive and profitable when they've got some pretty strong headwinds from that high exchange rate.
Given the payments for Southern Response Unit in the last year came in a fair bit more than was forecast, how much of a risk is that for your surplus targets? I see it's listed as a change, unquantified specific risk. Is that, how much of a risk is that?
Well, look at something of a risk, anything to do with the Christchurch earthquake is, and we'll go through a cycle of re-estimating all those over the next, in the run-up to the budget. As Treasury said, they've lifted their estimate of the capital cost of rebuilding Christchurch to 30 billion. And I would expect that some of that increase is likely to flow through to the government books. That's one of any number of uncertainties we could go through over the next that could arise over the next couple of years. And our response to all that is to make sure that the things we can control are well under control. Any other questions? Very good. Thank you.